This question tests understanding of the weighted average cost of capital WACC and the effect of tax-deductible interest on debt financing. WACC represents the average cost of financing from all long-term sources, weighted according to their proportions in the firm's capital structure. The company uses only long-term debt and common equity, so the capital structure contains only two components. Students should recognize that the cost of debt must be adjusted for taxes, because interest expense is tax-deductible, while the cost of common equity is not adjusted for taxes. The information provided is: pre-tax cost of debt equals 8% corporate tax rate equals 40% cost of common equity equals 15% WACC equals 10.41%. After considering the tax deduction, the effective cost of debt becomes 4.8%, 60% of 8%. Since debt is less expensive than equity after taxes, increasing the proportion of debt lowers the WACC. By determining the debt proportion that produces a weighted average of 10.41%, the debt component is found to be approximately 45% of total capital. Choice analysis. A. 34%. Incorrect. This debt proportion would produce a WACC higher than the stated 10.41% and does not fit the given information. B. 45%. Correct. A capital structure consisting of approximately 45% debt and 55% equity produces the stated weighted average cost of capital after considering the debt tax shield. C. 55%. Incorrect. This level of debt would reduce the WACC below the stated value because more low-cost after-tax debt would be used. D. 66%. Incorrect. This would produce an even lower WACC and is inconsistent with the information provided. Correct answer: B. 45%. Exam tip: in WACC problems, remember that debt is adjusted for taxes because interest is tax-deductible, while equity is not. When the cost of equity exceeds the after-tax cost of debt, increasing debt generally lowers WACC, provided financial risk remains manageable. Understanding this relationship is essential for capital structure and corporate finance questions. This question tests the concept of the weighted average cost of capital WACC, which represents the average cost a company incurs to finance its assets using common equity, preferred stock, and debt. WACC is widely used in capital budgeting because it serves as the minimum required return for investment projects of similar risk. The question provides the capital structure weights and the cost of each financing source. 50% common stock with a cost of 12%, 30% preferred stock with a cost of 10%, 20% debt with a pre-tax cost of 5% corporate tax rate equals 30%. Students should recognize that only the cost of debt is adjusted for taxes, since interest expense is tax-deductible. The after-tax cost of debt is therefore 3.5%, while the costs of common and preferred stock remain unchanged because dividends are not tax-deductible. The weighted contribution of each financing source is: common stock, 6.0% preferred stock, 3.0% debt, after tax 0.7%. Adding these weighted costs produces a WACC of 9.7%. Choice analysis. A. 8.8%. Incorrect. This understates the weighted average cost and likely miscalculates one or more component weights. B. 9.7%. Correct. This correctly combines the weighted costs of common equity, preferred stock, and after-tax debt, giving the company's overall cost of capital. C. 10%. Incorrect. This likely results from failing to adjust the cost of debt for the tax shield. D. 18.9%. Incorrect. This significantly overstates WACC and is inconsistent with the relatively low financing costs provided. Correct answer: B. 9.7%. Exam tip: when calculating WACC, always weight each financing source by its proportion in the capital structure. Remember that interest on debt is tax-deductible, so use the after-tax cost of debt, while common equity and preferred stock costs are not adjusted for taxes because dividends are paid from after-tax income. This question tests understanding of zero-coupon bonds and the factors that determine their yield to maturity (YTM). A zero-coupon bond pays no periodic interest coupon payments. Instead, investors purchase the bond at a discount and receive the face value at maturity. The investor's return comes entirely from the increase in value between the purchase price and the maturity value. The yield to maturity depends mainly on two factors: the purchase price relative to the face value, the time remaining until maturity. For bonds with the same maturity value of $1,000, a lower purchase price produces a higher return because the investor gains more by maturity. Likewise, for bonds purchased at the same price, a shorter maturity produces a higher annualized return because the gain is earned over fewer years. Therefore, the bond that combines the lowest price, $300, with the shortest maturity, 10 years, will provide the highest yield to maturity. Choice analysis. A. $300 price and matures in 10 years. Correct. This bond offers the largest appreciation, from $300 to $1,000, over the shortest time period. Consequently, it has the highest annualized yield. B. $500 price and matures in 10 years. Incorrect. Although the maturity is short, the higher purchase price reduces the investor's return compared with option A. C. $300 price and matures in 20 years. Incorrect. The low purchase price is attractive, but the gain is spread over 20 years, reducing the annualized yield. D. $500 price and matures in 20 years. Incorrect. This option combines a higher purchase price with a longer maturity, resulting in the lowest yield among the choices. Correct answer: A. $300 price and matures in 10 years. Exam tip: for zero coupon bonds, yield increases when the purchase price decreases and when the time to maturity decreases, assuming the same maturity value. A useful shortcut is lowest price plus shortest maturity equals highest yield to maturity. This question tests understanding of default risk in the bond market and the organizations that evaluate it. Default risk is the possibility that a bond issuer will fail to make scheduled interest payments or repay principal at maturity. Because investors cannot always independently assess an issuer's financial strength, specialized organizations provide independent evaluations of credit quality. The key concept is that credit rating agencies analyze a company's financial condition, cash flows, debt burden, and repayment capacity to assign credit ratings. These ratings help investors compare the relative credit risk of different bonds and estimate the likelihood of default. Higher ratings indicate lower default risk, while lower ratings indicate greater credit risk. Students should distinguish the roles of various financial institutions. Bond dealers, investment banks, and brokerage firms participate in trading or issuing securities, but they are not primarily responsible for providing independent credit assessments. Choice analysis. A. Bond dealers. Incorrect. Bond dealers facilitate the buying and selling of bonds in financial markets. Although they may provide market information, they do not independently evaluate the issuer's default risk. B. Investment banks. Incorrect. Investment banks help corporations issue securities, underwrite bond offerings, and provide financial advisory services. They are not the primary organizations that assign formal credit ratings. C. Credit rating agencies. Correct. Credit rating agencies specialize in assessing the creditworthiness of bond issuers and assigning ratings that reflect default risk. Their evaluations are widely used by investors when making bond investment decisions. D. Brokerage firms. Incorrect. Brokerage firms execute trades and provide investment recommendations, but generally rely on external credit ratings rather than issuing official default risk assessments. Correct answer: C. Credit rating agencies. Exam tip: when evaluating corporate bond default risk, think of credit rating agencies. Their ratings summarize the issuer's ability to meet its financial obligations and provide investors with a standardized measure of credit quality. In contrast, investment banks issue securities, bond dealers trade them, and brokerage firms facilitate transactions, but none serves as the primary independent evaluator of default risk.